Keisha, let's start with you. We have a nod this evening to investment icon Charlie Munger, who has passed away. Tell us who he was and how he changed the game.
Sure. All right. So Charlie Munger, within the investment community, we know him as, the GOAT. He's the right hand basically to Warren Buffett. And together they built Berkshire Hathaway, which is one of the largest value investing holding companies. Warren Buffett being known for his value investing strategies, and Charlie Munger being right beside him, sharing in those principles as well. For context, Berkshire Hathaway's their share price now is $549,240 US per share. That's the A series of the shares. So very expensive stock to buy, but still over the history of the stock, it's consistently grown because there's this value investing strategy that Berkshire Hathaway is known for. So Charlie Munger passed away recently, and I just wanted to pay homage to his great insights that he shared with the investing community. I personally have benefited a lot in my investing philosophy and how I see and approach investments just based on him and Warren Buffett. So I wanted to share 4 lessons coming from him. Number 1 being the big money is not in the buying and selling, but in the waiting. I know a lot of persons, a lot of people are in the quick flip, the quick money. You know my position on that. I'm a true fundamentalist that, I believe in finding solid companies and just holding on to them for the long term. That's really the strategy that Berkshire Hathaway has used as well, which has reaped millions, billions of dollars. The market cap for Berkshire Hathaway is 780 billion US. So a long-term strategy really pays off, and that's what they've done. I guess point number 2 would be buy wonderful companies at fair prices. I know Black Friday just passed, and everybody say, seal out. We're going after a lot of things that we want to. I personally use that time for Christmas shopping because you get really good deals. But similarly with investing, it's the same thing. You want to buy wonderful businesses at fair prices. And I talk a lot about the great investing blueprint because it rests on the same principle of we find great companies and we buy them at great prices as well. That's value investing in essence. And then also great opportunities are rare. So, most times we may think that, this sounds so good. And then next week, something else sounds so good. And then the week after that, something else again sounds so good. But in fact, great opportunities are rare. You're not going to see them every day. And the fact that you may be seeing something every day just means it's not great. And then it may just not be for you. That investing opportunity isn't for you. And also good businesses are ethical businesses. We're seeing a lot these days where a lot of companies are being drawn up in lawsuits, lots of business practices being called out, but you can't ever go wrong by investing in ethical companies. So I just kind of wanted to leave those lessons there and just thank Charlie Munger for everything he's done for the global investing community.
Yeah, I absolutely love those, especially that first one. The real money is not in the buying and selling, the everyday trading. That's the quick money, but the real money is in the waiting. And we always say that, have patience.
Yep.
Have patience. You got to be in it for the long haul, 10 years plus.
Yep.
Minimum 10 years. Keisha, I have a question for you. Well, it's really a comment from Andre Brown. Andre says, I have a different take on long-term investing due to experience. I've owned Ford stocks for over 11 years with minimal returns. Having Tesla would have been a better investment for a growing company. What do you say to Andre?
Well, I mean, I don't really know what time he would have bought Ford.
11 years ago.
Right. But has he bought at a high point at that time? Like the highest point in that period. So a lot of people chase stocks. When they're going to buy it after it's run up and then they're buying it. And yes, he's held it for 11 years, but has he taken advantage of downturns and averaged down his price? Likely not. With Tesla, yes, looking at it, it's new innovative technology. And that theme of, electric vehicles has been a rapidly growing area. But the thing is, just having the Ford stocks, and I was saying you have it for 11 years, fine. But were you averaging down? Were you consistently buying each month? Probably not. Similar thing would have to happen with Tesla as well. One company, however, is more of a growth company than the other. So that too, right? Ford is just now talking about launching more electric vehicles. That was Tesla's entire business model to begin with. So two different companies, one very mature, so slower growth, one new and innovative, so it would be faster growth.
Right. And you don't just want to buy and hold for buying and hold sake, because Warren Buffett said buy and hold. You do want to look for opportunities.
Right, but buy and hold also does not mean buy one time, hold forever. It means buy through dollar cost averaging and make sure that your price, it goes, he spoke about the price as well, ensuring that you have great pricing on the stock. So it's not just buy and leave it alone. You have to manage the price at which you bought. That comes through dollar cost averaging.
Another comment, and I'll ask Julian to respond to this one. This comment comes from Roswell. This is not the one. Roswell says, value investing is a good way to build up your equity. Stock market is trading low, and these prices we won't see in 4 years forward. Now is the time to buy. Do you agree with that, Julian? Keisha nodding vigorously, like, yes, she agrees. What do you think?
Yeah, definitely. Across the board, I think that we're seeing some of the best bargains available in the last 4 years at least. We could even go as far as saying 5 years, because it goes back to the interest rate story. So interest rates now are much higher than they would have been over the last 5 years. And what happens with interest rates is that as they rise, the prices of stocks and bonds tend to fall. So what we are seeing is that classical relationship between the two, i.e. stocks and bonds with interest rates. So because of that, we're getting a wider menu of bargains across the board, across sectors, across markets. So investors are able to buy now, get in at better entry points now, because there's going to be a time when interest rates enter a different cycle and move in a different direction. And with that, stocks and bonds are likely to rise again with that inverse relationship. So it's only a matter of time. But the key is to buy smart, because we can't buy junk at a cheap price and expect the junk to move. Not saying Ford is junk, but for argument's sake, Ford has faced a lot of operational challenges. So for instance, the US market, which is Ford's stomping ground, has taken on to Japanese cars big time. So Toyota, Honda, and those brands, if you notice, those cars are actually, even the sedans, they've been getting bigger and bigger. It's to cater to the American market. So what you find is that Ford has been losing market share over the last 11 years. So it's deeper than just Tesla and the disruption on the EV side. So it's really about starting at buying quality, then buying quality at a price that is attractive so that we can maximize our return.
Next comment is also for you, Julian. Who am I? Says, I'm on the hunt for companies stock price under 25 US a share, value underpriced companies. What do you think about that strategy?
Well, the interesting thing is, if your budget is 25 US per share, you'd have to ask, what exactly are you paying for? Because we don't just look at prices in a vacuum. We look at the earnings per share, the book value per share, and other metrics to identify if that $25 is justified, to see, as you said, whether or not it's overvalued or undervalued. So one stock can be $25 and it's overvalued based on how much profit per share it generates, and another stock can be $25 or even less, right? And it's telling a totally different story based on the earnings per share. So two stocks can have the same price. One is overvalued, one is undervalued, because one is generating more profit per share than the other. So it really comes down to, what is that price in relation to? Are we getting that for a good bargain because the company is very profitable, or are we getting that at a weaker value proposition because the company is not profitable? And even if it's not profitable, there might be something else moving it. Is it that there is innovative technology that has gotten regulatory approval, and that regulatory approval is likely to take effect in the next 3 months, which should open market share. So even though there's no profit, the regulatory story is likely to carry the company into a different phase. So all these things that we're discussing are called catalysts, and investments need catalysts, because even if a company is profitable and it doesn't have a catalyst, then the price is not likely to move. A catalyst is a fancy word, but it's simply something that's a trigger that's likely to cause the price to move. So we need to identify our groundwork. How profitable is the company? How well do we understand it? Does it have a catalyst, and understand how it trades? All of those things come together that should form our investment thesis.